Hi everybody! Today I'm going to talk to you about revenue and inventory related financial statement fraud. We're going to discuss how to identify and search for symptoms of revenue related fraud, understanding the importance of and ways to follow up on revenue related symptoms. Then I'm going to discuss the same topics but in terms of inventory related financial statement fraud schemes. I thought this chapter was pretty interesting because we're starting to see everything that we've learned in previous chapters come together to learn how to detect specific types of fraud. So let's get started. So as we saw in Chapter 11, studies sponsored by the Committee of Sponsoring Organizations found that over half of all financial statement frauds involved revenue and or receivable accounts, making them the most common account manipulated in financial statement fraud. So why do these accounts see the most financial statement fraud? Two reasons. One is the availability of acceptable alternatives for recognizing revenue. Every organization and industry is different, which makes it difficult to develop revenue recognition rules that can be applied to many business models in the economy. Therefore, revenue recognition usually requires significant judgment. Many questions need to be asked, such as does a company accept cash before or after delivering goods or services, or was a service completed, or has the product been shipped? This makes determining the proper revenue to record difficult and complex and creates opportunities for management to commit financial statement fraud. Another reason these accounts see so much financial statement fraud is because it's easy to use these accounts to manipulate net income by creating a revenue and a corresponding receivable. And another way to inflate net income is by recognizing revenues in the current period that shouldn't be recognized until the next period. Construction companies whose revenues depend on percentage of completion can misstate the completed work in order to recognize revenues early. And other revenue-related fraud is committed by creating fictitious sales and shipping documents, making up customers, forging contracts, or using topside journal entries, which we will discuss in a few minutes. So it is important to understand the revenue transactions in a company to understand how revenue frauds could be perpetrated. One of the first things you should do is analyze and diagram the company's revenue transactions with its customers. This is an example from the textbook, which provides a basic diagram of revenue transactions that could be created. Next, you'll want to analyze the accounts involved in each transaction and determine how each transaction can be misstated. So the table on the right can be used to organize your analysis of transactions, the accounts involved, and the potential fraud schemes that could occur. So if you look through this, you can see that the first transaction is the sale of goods and or services. And then if you look at the corresponding number on the right, you can see that the accounts involved include accounts receivable and revenues. And frauds that can occur here would be recording fictitious sales, recognizing revenues too early, or overstating real sales. The next transaction is estimate uncollectible receivables, which would affect the bad debt expense and allowance for doubtful accounts. And this could result in understating allowance for doubtful accounts and thus overstating receivables. Next is the accepted return goods from customers, which could affect the sales returns and accounts receivable, and the frauds involved in this include not recording return goods from customers or recording return goods at the end of the period or after the end of the period. The next would be to write off receivables as uncollectible. This would affect the allowance for doubtful accounts and accounts receivable. And the fraud in here would be to not write off the uncollectible receivables or write off the uncollectible receivable in a later period. The next transaction is to collect cash after the discount period. Accounts involved are the cash and accounts receivable. Fraud schemes here would include recording bank transfers as cash is received from customers, or manipulating cash received from related parties, or recording fictitious cash entries such as debiting cash and crediting accounts receivable. And the last transaction here shows collecting cash within the discount period. And these involve cash, sales discounts, and accounts receivable. And the scheme here would be not recording the discounts to a given customer. So common revenue-related fraud schemes that result in overstated revenues and net income include related party transactions, sham sales, bill and hold sales, side agreements, consignment sales, channel stuffing, lapping or kiting, redating or refreshing transactions, liberal return policies, partial shipment, improper cutoff, and round tripping. It is also possible to understate revenues and net income, but these frauds are rare and typically only occur when a company is trying to smooth income or lower net income to pay lower taxes. So in identifying revenue-related fraud symptoms, we're going to look at the same fraud symptoms that we've looked at in previous chapters, which include analytical symptoms, accounting or documentary symptoms, control symptoms, behavioral and verbal symptoms, lifestyle symptoms, and tips and complaints. Analytical symptoms are economic events, accounting transactions, or financial or non-financial relationships that are unusual. They are usually too good to be true and unexpected or unexplained. A helpful way to discover analytical symptoms of revenue fraud is to compare changes in non-financial performance measures. These measures include square footage of office space, warehouse or manufacturing space, number of employees or customers, and number of product lines or types. You can find more examples in Table 12.2 on page 397 of your textbook. For now, we're going to look at these analytical symptoms pertaining to revenue, which include revenue or sales that appear too high, especially relative to non-financial performance measures, sales discounts, sales returns, bad debt expense, or allowance for doubtful accounts that appear to be too low, accounts receivable that is too high or increasing too fast, not enough cash collected compared to revenues, unusual entries at the end of the accounting period that increase revenues, rapid changes in the mix or types of revenues, unusual relationships between cost revenues, cash and receivables, or between two revenue-related accounts, and significant new unknown customers, revenue-related transactions not recorded in a complete or timely manner or improperly recorded as to the amount, accounting period, classification, or entity policy, last-minute revenue adjustments by the entity that significantly improve financial results, large and growing receivable balance with little or no cash received from the customer, sales of assets that are very similar to subsequent purchases at similar amounts. Accounting or documentary symptoms include unsupported or unauthorized revenue-related balances or transactions, missing documents in the revenue cycle, only photocopies of documents exist to support revenue transactions when originals should exist, significant unexplained items on bank or other reconciliations, revenue-related ledgers that do not balance, unusual discrepancies between the entity's revenue-related records and corroborating evidence, non-standard journal entries posted by top management or near the end of the accounting period or posted at unusual times, such as on weekends, late nights, or on holidays, or journal entries for round dollar amounts or for amounts that do not comply with Benford's law. So control symptoms include management override of significant internal controls pertaining to the revenue cycle, new, unusual, or large customers that appear to not have gone through proper customer approval processes, and weaknesses in the cut-off processes or other key accounting processes. Behavioral or verbal symptoms include inconsistent, vague, or implausible responses from management or employees arising from revenue inquiries or analytical procedures, denied access to facilities, employees, records, customers, vendors, or others who revenue-related audit evidence might be sought, undue time pressures imposed by management to resolve contentious or complex revenue-related issues, unusual delays by the entity in providing requested information on revenues, untrue responses by management to queries about revenues, suspicious behavior from management when asked about revenue-related transaction accounts. And then also there are lifestyle symptoms and tips and complaints. These are pretty similar to what we've already seen in past chapters, and I will discuss them, but it'll be in a few more minutes. So when searching for revenue-related fraud symptoms, fraud can be found in two ways. One, by discovering symptoms by chance, or proactively searching for the symptoms. Developments in technology and results of fraud research allow investigators and auditors to have the tools and knowledge to proactively search for fraud symptoms. So analytical symptoms relating to revenue accounts involve accounts being too high or low, increasing too fast or not fast enough, or other abnormal relationships. But the question to ask is, what is too high or too low and relative to what? So specific analysis that are conducted usually include, from this table here from the textbook, you can start on the left column and see that it usually includes analyzing financial balances and relationships within financial statements, or comparing financial statement amounts or relationships with related information. There are two common ways to performing a within statement analysis, which include looking for unusual changes in account balances from period to period and relationships from period to period. And just to touch on these for a couple minutes, there are three different ways to focus on changes in recorded account balances. First is to focus on and calculate changes in the actual financial statement numbers themselves. Second, we could also use horizontal analysis, which we learned about in Chapter 6, to examine percentage changes in account balances from period to period. And the third method is to study the statement of cash flows. In examining changes in revenue-related relationships can be done by focusing on revenue-related ratios from period to period, or to convert financial statement percentages and perform vertical analysis. Some of the most common ratios that are used to find revenue fraud symptoms include gross profit margin ratio, or sales return percentage ratio, accounts receivable turnover, asset turnover ratio, working capital turnover ratio, and earnings per share. And then you can also compare financial results and trends of the company with similar firms in the industry, or compare recorded revenue in the financial statements with assets or other financial or non-financial information. Comparing the results to trends in the same industry can be very helpful. If performing well while other companies in the industry are performing bad, this may be a sign of fraud. One example of this is WorldCom. The company was having strong performance in the telecom industry when it was committing fraud, and other companies were not. Remember, economic and industry-wide factors typically affect similar companies in the same way. And then in comparing financial statement amounts with the assets they represent isn't as effective for discovering revenue-related fraud as it is for other types of fraud. So one common way that management will commit fraud is referred to as topside journal entries, which I mentioned earlier. These journal entries are posting one or more journal entries directly to the accounting records. So this bypasses normal journal entry processes and overrides controls. These entries may be posted directly to the general ledger instead of a subsidiary ledger, meaning that no supporting evidence or information is maintained. Computer software makes it easier to find potentially fraudulent entries amongst the millions of journal entries a large corporation may have. And these softwares will flag entries, and it's the investigator or auditor's responsibility to analyze these entries and ask the 5 W's: who, what, when, where, and why. Who posted the entry, such as was it a member of top management? What was the entry for? When was the entry posted? Was it posted at an odd time or at the end of an accounting period? Where was the entry posted in the accounting system, such as was it on the general ledger or in a subsidiary ledger? And why was the entry posted? An example of this again is WorldCom. Their internal auditor, Gene Morse, used technology to sort through the company's journal entries when he discovered a $500 million debit to fixed asset account. And upon following up on this, discovered that it was actually a part of a $1.7 billion entry that was at the heart of the WorldCom fraud in 2001. So when actively searching for control symptoms, it's good to assess the control weaknesses or overrides within a company. Control breakdowns are not just something to be fixed in the future. They need to be examined and determined if they have been abused in the past. You should also assess effectiveness of the control environment. As we've learned before, a weak or inactive audit committee or board can lead to unethical behavior. And be aware the control environment may still appear strong, but management may be concealing that they override controls. And this is where the fraud triangle comes to play in this chapter. If management is feeling pressure to perform well and rationalizes that the fraud will only be short term, all they need is opportunity. And management could perceive the opportunity as a control weakness or breakdown. And then we have revenue-related frauds on our hands. So when actively searching for behavioral or verbal and lifestyle symptoms, it's important to know that lifestyle symptoms are difficult to detect because financial statement fraud does not immediately or directly benefit the perpetrators. Usually this is done by top management who may already be wealthy, so it may be difficult to see if there is an increase in the perpetrator's net worth. Also, audit standards require auditors to make inquiries of management and others regarding fraud. AUC 240 requires auditors to inquire management, audit committee, internal audit personnel, and other employees about possible fraud or red flags. This is important because management is probably concealing fraud from the audit committee and internal audit, but lower level employees may have knowledge of fraud because they may have been asked to perform suspicious journal entries. Also, employees with information about fraudulent activity may be afraid to come out and speak up on their own, but if questioned, they're likely to give up that information. And in actively searching for tips and complaints, set up a hotline or other system where people can report fraud anonymously. If a company already has a whistleblowing system, such as a hotline, auditors and investigators should review the hotline records to see if there is any information that can be used and to check to see if the company has followed up on any tips that they have received. Any tips or complaints about key personnel or fraud related to the financial statements, controls, or regulatory violations should be investigated vigorously. Next, I'm going to talk about inventory and cost of goods sold fraud. After revenue, these accounts see the most financial statement fraud. To understand why these are so common, you need to understand how the inventory accounts affect the income statement and how cost of goods sold is calculated and the effect it has on inventory. So as you can see here, we have a basic income statement and calculation of cost of goods sold that came from the textbook. I'm just going to go over this really quick just to show what effects can have when you overstate inventory. So if you look at the cost of goods sold calculation on the right, you can see that ending inventory is overstated, causing cost of goods sold to be understated. Then looking at the income statement, you can see that if cost of goods sold is understated, then gross margin and net income are overstated. What makes this interesting is that manipulating inventory is very difficult to maintain because it also affects the next period. Looking back at the cost of goods sold calculation, you can see that if ending inventory in period 1 is overstated, then beginning inventory in period 2 will be overstated, making goods available for sale and cost of goods sold overstated in period 2. So basically, the perpetrator has to overstate ending inventory in period 2 by an even larger amount to offset the effect of having overstated beginning inventory and to commit more fraud. Other calculations can be done to affect net income, but this example is the most common inventory fraud scheme because it increases net income and recorded assets. So it also makes the balance sheet look better. To understand inventory-related fraud, I will follow the same process as I did with revenue-related fraud. I will start with the most common inventory-related fraud schemes, which include double counting, capitalizing costs that should be expensed, cut-off problems, overestimating inventory, bill and hold sales, and consigned inventory. So as with revenue-related fraud, to identify the financial statement fraud exposures involving inventory, you will want to make a diagram of the company's inventory-related transactions. And again, we have a basic diagram of transactions, but this time it includes inventory. And again, you will want to make a table like this one on the right to determine the accounts involved in the fraud schemes that may incur. So going down the list here, we can see that the first transaction is purchase of inventory. So the accounts that can be involved in this is inventory accounts and accounts payable. The fraud schemes include understate purchases, record purchases too late, and do not record purchases. The next transaction is return merchandise to suppliers, which can affect the accounts payable and inventory. And this can overstate returns, or they may record returns in an earlier period. The next transaction is to pay vendor within the discount period. This involves the accounts payable, inventory, and cash accounts, And the schemes here overstate discounts or do not reduce inventory counts. The next transactions pay vendor without discount, and the accounts involved here are accounts payable and cash, and this will be considered more in Chapter 13. The next transaction's inventory is sold and cost of goods sold is recognized. This affects the cost of goods sold account and inventory account, and fraud schemes include record at too low of an amount or do not record cost of goods sold or reduce inventory. Next, inventory becomes obsolete and is written down. The accounts involved here is loss on write-down of inventory and inventory accounts. The scheme here includes do not write off or write down obsolete inventory. Next transaction's inventory quantities are estimated. This affects inventory shrinkage or inventory, and this will overstate inventory. Next one is inventory quantities are counted, involving inventory shrinkage account again and inventory accounts. And fraud schemes here overcount inventory or capitalize amounts that should be expensed. And finally, we have inventory cost is determined, and the accounts here is inventory accounts and cost of goods sold, and fraud schemes include use of incorrect costs, make incorrect extensions, and recording fictitious inventory. Again, we will see the 6 categories of fraud symptoms, but this time we will see how they apply to inventory and cost of goods sold frauds. So analytical symptoms include reported inventory balances that appear too high or are increasing too fast, reported cost of goods sold balances that appear too low or are decreasing too fast, reported purchase returns that appear too high or are increasing too rapidly, reported purchase discounts that appear too high or are increasing too rapidly, reported purchases that appear too low for sales or inventory levels, and capitalized inventory that looks as if it should be. Accounting or documentary symptoms include inventory or cost of goods sold transactions that are not recorded in a complete or timely manner or improperly recorded as to the amount, accounting period, or classification or entity, unsupported or unauthorized inventory or cost of goods sold related transactions, end of period inventory or cost of goods sold adjustments that significantly change the entity's financial results, missing documents related to inventory and or cost of goods sold, unavailability of other than photocopied documents to support inventory or cost of goods sold transactions when original documents should exist, cost of goods sold related accounting records that do not balance, unusual discrepancies between the entity's inventory and cost of goods sold records or corroborating evidence, systematic differences between inventory counts and inventory records, differences between receiving reports and inventory actually received, or purchase orders, purchase invoices, receiving records, and inventory records. Purchases from suppliers are not approved on the vendor list, missing inventory when performing inventory counts, duplicate purchase orders or inventory numbers, and non-standard journal entries in terms of the who, what, when, where, and why. As for control symptoms, behavioral or verbal symptoms, lifestyle symptoms, and tips and complaints, these are all literally the same as they were pertaining to revenue-related fraud, but instead of them saying revenue-related accounts, they focus more on inventory, purchase accounts, and cost of goods sold accounts, or other inventory-related accounts. So for the sake of time, I'm not going to repeat the same ones that I already talked about earlier. So in searching for inventory and cost of goods sold analytical symptoms, there's 2 ways again to find these, which is finding them by chance or proactively searching for them. And specific ways to search depends on the kinds of symptoms you are looking for. And symptoms relate to accounts or relationships being too high or too low or having unusual characteristics. And again, you need a point of reference or some basis that recorded amounts can be compared to. So again, here we have the same table that we saw earlier, but this time the top row mentions inventory instead of revenue. So I underlined where they said inventory. And I'm not going to get into these in detail again, but because each one of them are the same, but I just want to mention that some of the ratios that can be used to look for unusual changes in inventory and cost of goods sold relationships from period to period are gross profit or margin ratio, inventory turnover, asset turnover, operating performance ratio, working capital turnover, and earnings per share.